Well, Nigeria's MPC has kept its key rate at 12% for the 10th time in a row, citing successes in stabilising the naira and lowering inflation. Now, after the announcement, CNBC Africa's Umo Ibrahim caught up with the Nigerian Central Bank Governor, Sanusi for a look at the impact of uncertainties in major foreign nations on the Nigerian economy.
1 trillion naira is a lot of money. The good thing is obviously we're not pumping an additional 1 trillion naira into the system. The net effect might actually be a contraction in money supply. And because AMCON is effectively cancelling 1 trillion naira of bonds that it currently owes the holders and exchanging that with 1 trillion naira of securities that it will be holding on its asset book. So you have a reduction in net credit to the private sector of 1 trillion. So that is basically what we've got to manage. How much of that is in securities? How much money do we need to put in? A lot depends on whether those securities are being used right now by banks for liquidity. I don't think so. And therefore, in terms of affecting market liquidity, it will be negligible.
Since the last meeting, would you say the MPC is less or more worried about the global economic environment and the flow of global liquidity?
I mean, there's a lot of uncertainty still. In the United States, the deficits have come in good, but there's still a lot of controversy over how they're going to deal with the budget issues and government spending and government borrowing. The EU remains obviously the biggest risk. They're still in recession. The British economy, the jury is still out. Austerity seems to be hurting the economy. The Chancellor seems determined to continue with austerity. We think that the world needs to learn from 1929 and recognize that austerity does not deliver growth. In Japan, there's a big risk being taken with expansionary fiscal policy and QE. If it works, it will be a fantastic thing for the advanced economies. If it doesn't, it will simply boost asset prices, but certainly it will increase the profitability and competitiveness of Japanese manufacturing. So by and large, I think in terms of a global outlook, it's a bit more positive than it was at the last MPC meeting. Domestically, there are concerns about our own oil production. There are concerns about the price of oil. There are concerns about government fiscal spending. So in terms of the fiscal position of government, the impact of oil theft on its revenues, the impact of emergency on its expenditure, and possibly the pressure by the governors to monetize excess crude account, and possibly what may happen as we start approaching 2014 and elections, we think that the risks to stability are increasing.
What are your expectations for loan growth in the banking sector this year? Do you anticipate a greater rate of growth than we've seen in the first half of the year in the second half?
Well, I think it's been good. I mean, 17.7%, including government credit, has not been bad. The private sector credit has been growing. It's not growing very fast, but what is becoming very clear is that a number of banks are booking many new loans to small borrowers. So in terms of quantum, if you're not doing margin lending, if you're not lending to the power sector because reforms have not yet taken off, not into the oil sector, in terms of quantum, you're not going to get a 20, 30, 40% growth in a loan book by lending to 11,000 or 20,000 retail customers and SMEs. So we've seen the growth, but we've seen also growth that is more and more diversified, which is very good. We want the banks to move into retail, we want the banks to move into SME, and that will take a longer time. If we, for example, remove the cap on margin lending, now the capital market is going on, it's very easy to just lend billions and billions to stockbrokers, and you see a loan growth. This is what happened before the crisis. So I want to see loan growth, but I also understand that a loan growth that is too rapid and that is not tied to structural reforms in the economy simply leads to very high level of financialization and builds up risks in the system that will blow up 3-4 years down the line.
Given the consistent flow of funds into Nigeria's bond and equity markets, the negative impact of a withdrawal of funds could be significant. How prepared is the central bank to deal with the impact of a withdrawal of funds?
Well, I think a number of things need to be looked at. First of all, these portfolio funds are about 25% of our reserves. Okay, we know exactly how much It is 10% of the funds are in fixed income, 90% in equities. Foreign investors control about 42% of the equities market compared to about 70% before the last crisis. So it's actually more stable. They're concerned about the outlook for exchange rates. They're concerned about stability, and I think we've provided enough comfort as to our commitment to a stable exchange rate and our commitment to keeping to maintaining stability. I don't. If you take inflow last year, for example, when we did the analysis, about $12 billion came in. 75% of that came through one bank. Okay, we know the investors, and these are real money funds. They are not hedge funds. They're not there to speculate. They're taking a strategic position. So the only risk you run is if you have a major decline in the price of oil and output, and there's a very strong likelihood of a major depreciation of the currency, they begin to see an exit. Basically, they fly out the door because they don't want to lose on the currency front. I don't see that happening. So we're very much on top of it. This is not what you'd call hot money in that sense. There is a slowdown in the inflows, which is maybe good timing, not because of anything we've done, but because of the other macro and global factors. The QE in Japan means there are opportunities in other emerging markets. The decline in oil price and output means that there are concerns about exchange rates. So we've actually seen a tapering of new money coming in, okay? But the money that's in there has stayed.